There's so much going on in the world right now, and we need to be aware of it all. It's important to see what's happening with commodities in particular to give us some insight as to what's going to happen with our own bills, our energy, our food, and so on. The first thing I want to look at is $100 crude oil. Not that long ago, it was in the negative, and here we are approaching $100 a barrel. The second thing is what will happen. We are looking at the indicators, and I think it is imperative that we see what's happening right here. And the third is follow the money. Where is money going right now? I will show you that directly from the source. I've got all of that and more. Let's begin. So let's start right here. $100 oil threatens to compound world economy inflationary shock. You could look at this at a time in which everything is going up, but compare oil to some of these other commodities, and believe it or not, it has not risen as much, even though this is going to hurt a lot of people. The price of oil connected with not just gasoline, but think about how many products. More price gains seen as $100 neared for the first time since 2014. Economists warn that higher energy costs will stoke inflation. That's absolutely true. And the fact remains is that it's not just the United States, it's everywhere around the world. The prices will, of course, fluctuate. If you're in California, you're paying one price for your gas, then let's say somebody in Texas. It's not going to be the same. But of course, there's always going to be an effect to some degree. Oil surged toward $100 a barrel for the first time since 2014 is threatening to deal a double blow to the world economy by further denting growth prospects and driving up inflation. So the worry here is that if we enter a period in which oil remains elevated, this could, of course, slow down growth and could further exacerbate the risk for a recession. There's already so much going on. This could really put a dent in what had been all assured that 2022 is going to be fast growth. Stocks are going to move up by 20%. The economy is going to roar back to life and so on. Well, we'll see what happens. Here we have Fed's rush to catch up on inflation raises the US recession concerns. And that's what we have. The Federal Reserve going in and stepping up their measures of reducing their purchases of the mortgage-backed securities and the treasuries. And at the same time, they have to increase interest rates. All of this needs to be done at a rapid pace. By the time you're watching this video, we may have some new information that comes out related to what the Federal Reserve has said. I covered it in the previous video talking about the Fed's secret meeting. If you haven't seen that already, highly recommend checking it out. Okay, we're going to find out that information, and of course, I will keep you up to date on that. If you want to know what's going to happen with the Fed exactly, I cover every single detail. Simply hit that thumbs up button so that you can be assured you will get the next video. Taking a look here, back during a time in which so many people seem to have forgotten, 1970s, hot inflation. Here you have this, just a quick little point. It took Fed Chair Paul Volcker wisdom and courage to break that inflation, but those are hard decisions. They came late with huge costs. 3 years of a recession. Is there a Volcker type among the current generation of policymakers? I don't see one. Obviously, we know that is the case. They're not going to do that. But I would make the case here that we don't need that level, a 20% interest rate, to have roughly the same kind of impact that we had back then. I think because of, interest rates, depending on where you look, they were generally much higher. There wasn't all this quantitative easing and so on. If you put these two factors in, an interest rate hike that is moderate would be, equivalent. But we'll see. Depends on how bad really inflation gets. We're not using the real numbers when we look at inflation. We're using the fake PCE. We're using the CPI. That's not going to be real, obviously. But you can look at it even with the fake stats, and it still looks terrible. Inflation was the hottest in Atlanta and the mildest in San Francisco in 2021, because of course people started to look, okay, I can't take this anymore. I got to get out of these places and I got to move in to others. Florida saw a massive influx of people moving into the residential side, but also office real estate was really hot. But it's also in, even Tennessee, we're seeing a little bit of that. Georgia, obviously, Arizona, and other places, okay? Look at this. Inflation is everywhere, including places you might not expect. The article gets into the details of it. I'm just going to mention this really quickly. Allstate took a loss on auto insurance underwriting due to rising costs of used cars. Altria expects higher payments in the tobacco settlement. So it was indexed to inflation in that case there, and now inflation is higher, so they got to pay more. So think about how this affects different businesses and people all along. It's not just one number. It's really so much more. And this one upset me, okay? You can give me inflation numbers and all kinds of stuff all day long. But when the avocado prices go up, now it's personal. Okay, you can see the Mexican avocado price is 20-pound box, nearly $27, the highest price we have seen. This chart goes back to 2002, the highest price that we have seen at this time of year. And it looks to be heading higher and higher and higher. Not a good thing, right? And this is just showing us, which will connect us into the next part. Inflation spiraling out of control, the Federal Reserve increasingly hawkish, investors continue to pile into stocks. In fact, according to the EPFR, I always bring in the data from the EPFR, they are basically giving you exactly where the money is going to and from. U.S. large caps attracted inflows of $34 billion, the most ever. The most ever. In total, equity funds pulled in another $46 billion in the week before a hotter than expected U.S. inflation print fueled concerns of more aggressive hikes. Now let's get into it, okay? I want to show you that. That article, by the way, does cover some more information. So if you're interested, check it out. But let's look at this. AI managed ETF is underperforming the S&P 500 index so far this year. And what I wanted to say here is that the money moves in, but it doesn't necessarily move into a good place. You got to see where, all the nuances. It doesn't mean money going in necessarily brings you a return. Okay, watch out. Watch that very clearly. That's all I'm trying to say. This is Goldman Sachs. Scenario analysis around our baseline S&P 500 price target of 4,900. So that would be right there. But look at this. In the case of lower inflation and fewer Fed hikes, Goldman Sachs believes that the year-end 2022, the S&P 500 will be 5,500. What do you think? I'm interested to hear your thoughts. What do you think? End of 2022, what's it going to be? This right here is just showing you S&P performance when the 10-year, 2-year spread is between 25 to 75 basis points and falling. What is this all about? Essentially, imagine this. When you have a 10-year bond, you would think, 10-year bond, I am putting my money out there for 10 years, I better get a good return. If it's 2 years, well, they would give me less of a return because the term is not longer. It's not that long, you could say, or at least in comparison. But what happens when that flips? Suddenly, there's more of a return on the 2-year than the 10-year. That's when you know things are getting screwed up. And of course, that is a very big signal. So you look at the S&P performance during these periods, and on average, over the next 120 days, 9.13%. Go down further, percent positive. Over that 120-day period, 89%, it's positive. So it doesn't necessarily mean that, okay, you have a yield curve inversion and the markets just tumble immediately. It is, however, a signal, a warning signal. market implied number of hikes and months post liftoff. This is the Fed, ECB, and the BOE. We will see what happens. All I'm trying to show you here is that, especially for the ECB, who knows what they're going to do. They're really desperate for inflation at this time. Bank of England, different story, of course. The Federal Reserve seems to be going through with this, and we will see what happens. This is just, again, the inversion of the 2-year, 10-year gives approximately 18 months warning of a recession with banks underperforming shortly thereafter. Okay, things change in an instant, and that's what I wanted to cover really quickly. I want to go through this. Okay, we're going to look at what's happening in, following the money. Where's it going to? You need to know this. If you have a retirement account, if you've got a portfolio, if you own stocks, if you own a house, you want to know where the money is. Look, global equity fund flows, one of the highest we have seen in a very long time. Okay, looking at this, flows into global equity funds, seeing how much money has been moving in is truly insane, truly. Here you could see global equity inflows by year. Now what they're showing us at this time, so write this down if I grab the highlighter really quickly. This right here is year to date, okay? But this would be an annualized number. It would be the most ever if it continues. We'll see what happens. It's obviously very early. Global money market fund flows. People are selling out of that and they're putting their money into equities. Okay, that's what you need to know. They're taking money out of cash and they're putting it into equities. Global bond fund flows. Again, they are net sellers. It's been a few weeks of that actually. And then all I wanted to show you here really quickly was that investors are selling out of growth. And that could be worrisome for those who are heavily invested and leveraged in that. So be very careful. And then here, last one, cumulative fund flows. Where's the money going? Non-US equity funds. Look at the period here. So you could see throughout this period, no question, okay? No question, US equities have risen from that period of time, March 2020, even into the end of 2020. Where's that money? This is not the actual performance of the stocks. We're talking about fund flows, how much money had been moving in. But non-US equity has seen a massive surge. And I've covered it many times before, but Brazil's stock market over the last several months has really done well. Why? Well, it got hit really hard. So you're going to see that sort of snapback. And that's just one example. Anyway, that's the information for today. I hope you appreciate it. Now you are completely updated on what's happening. You know where the money is going to and from. You can make more informed decisions. If you appreciate that information, hit that thumbs up button. I do thank you for that. It helps to support me, but also helps to notify others out there saying, hey, this is good stuff. And you could simply make that happen by clicking the like button. If you haven't seen this video yet, you got to check it out. Click it and I'll see you there.